The government of India remained focused on augmenting economic growth, by remaining committed to capital expenditure and resisting the temptations of populism in the year prior to the general elections. The Union budget for financial year 2023-24 was a 4C budget focusing on consolidation, consumption, credit, and Capex. The fiscal deficit for financial year 2023 was retained at 6.4% of GDP and projected at 5.9% for financial year 2024. The government's adherence to fiscal consolidation is a positive sign for fixed income markets. To fund its fiscal deficit, the government has planned gross borrowings from the market of Rs 15.4 trillion, which was also in line with market expectations. Hence fixed income yields have remained stable. To ensure consumer sentiment remains buoyant, the government provided complete tax exemption for individuals with income up to Rs 7 lakhs, and reduced the surcharge for the highest tax bracket from 37% to 25%, both applicable under the new tax regime. An increase in credit to the agriculture sector, and a revamped credit guarantee scheme for MSMEs, show an intent to strengthen the overall financial sector further. Credit growth is steadily inching upwards, led largely by retail and MSMEs. With Indian corporates having significantly deleveraged their balance sheets over the last few years, there is a significant opportunity to expand corporate credit going forward. The Capex outlay of Rs 10 trillion is a big positive for the infrastructure-oriented sectors and financiers. Listed corporate Capex, which had stagnated over the last few years, has seen meaningful pickup and aggregate capacity utilization has improved to over 70%. Earnings growth is likely to be steady for the next few years. As per the temperature gauge index, valuations are still in fair value zone. For incremental investments, we continue to suggest 50% deployment immediately, and 50% to be staggered over 3 to 6 months, while being able to accelerate deployment during sharp corrections. Based on trailing 12 months, Nifty 50 EPS, temperature gauge index, suggests that large cap valuations are still in fair zone. We maintain a bias towards multi-cap and select mid and small cap strategies across MF, PMS, and AIF platforms. The RBI hiked the repo rate by 25 bips to 6.5% in its recent policy. The yield curve in India has flattened out, with the 1-year to 10-year G-Sec yields trading in a narrow band of 7 to 7.35%. Earnings growth is likely to be steady for the next few years. Hence, for fixed income portfolios, we suggest core allocation to a 4 to 5 year maturity segment through high credit quality, target maturity debt funds, which invest in a combination of G-Sec, state development loans, and AAA-rated instruments. Tactical allocation to select high-yield strategies, MLDs, REITs, and InvITs, can help enhance the yield on fixed income portfolios. Delphi, ASAP, is an all-weather strategy that benefits from asset class diversification and yearly rebalancing. It is positioned as a superior alternative to fixed income,